Hello. So a warm welcome to Authors Guild members and many other writers joining us today. We're here for Tax Tips for Authors with Robert Pesce, Treasurer of the Authors Guild Foundation, our charitable arm. Our foundation is able to host educational webinars such as this, thanks to the generous support of our donors, so that we can support working writers in the business of writing. And we're here today with Robert Pesce, a partner in Marcum LLP's Tax and Business Services Division and their national partner in charge of the Accounting Services Group. He has more than 30 years of experience with an outstanding reputation for developing strong relationships with clients in the entertainment industry, as well as professional services firms. His ability to successfully work with actors, authors, and agencies led to his instrumental role in the founding of Marcum's Media and Entertainment Group. He's often engaged by clients for business and tax saving strategies, and we are so happy to have him serve on our foundation board and for being here today. So for authors, tax time has its own special concerns. So Mr. Pesce, thanks for joining us. He'll answer as many of your questions as possible. We have a big crowd today, lots of questions pre-submitted, but feel free to use the Q&A box below to post any questions you have, and you can turn on the closed captioning for subtitles if you'd like. And with that, I'll turn it over to Robert Pesce. Thank you.
All right. Well, thank you. Hello, everybody. Nice to be here again. For some of you maybe have seen or heard the presentation before. I hope it's refreshing for those who have heard it, and for those who have not, have fun. All right. So we got a bunch of questions from you in advance, and I thought I'd just kind of warm up the room with those questions, and then we'll get into the material. Somebody was wondering about 1099s, requirements for us authors to issue 1099s to people that provide services to us. And the answer is yes. If you paid somebody to provide services to you, whether it was an audio book narrator or some kind of a researcher or anything that someone did for you that you paid them more than $600 for during the year, you're supposed to issue a 1099 to them, reporting to them and to the government what you paid them. Somebody was asking about royalties, whether or not they're subject to Social Security tax. In general, the answer is yes. So advances, royalties paid to a writer, that's considered self-employment income. It gets reported on Schedule C. It is subject to self-employment tax, which is Social Security and Medicare tax. And there are exceptions to that rule. I have seen situations where somebody inherited a royalty stream from somebody. The person who inherited the royalties did not create the property, is not an author, has nothing to do with being in the business of writing. And in that case, that person would record that income as royalty income, not take deductions against it. It's not a business. It's not subject to self-employment tax. It's subject to regular taxes, but not Social Security tax. That's the only exception to that rule that I can think of. Somebody was asking about losses that writers might have, and people are asking a lot of questions about hobby rules. So I can tell you that businesses, and that you all are in a business as writers, businesses sometimes have losses, and those losses are allowed and reportable and deductible on your tax return, and you should not hesitate to report them. Everybody has one of those years once in a while. You should get concerned if you have years like that that repeat themselves in multiple years. After 3 years, we start talking to our clients about whether or not the business is really a business or if it's some kind of a hobby. And it's very subjective and gray, but I would say the rule for me is to be thinking about that once you have 3 consecutive years of losses. People want to know how to choose a tax advisor for authors. Well, most of my clients appreciate the fact that I'm an expert in what they do. I understand what they do. I can give them good advice. They don't have to think about the right questions to ask me because I know the right questions to ask them. So if you're a successful author and you want to pay the least amount of taxes legally possible, you should be working with an accountant that understands your profession. If you're earning 7 figures or more and are incorporated, does your salary need to be approximately 50% of your income? No, I'll get more into that in the presentation. People want to know about whether or not they need to pay taxes in states that they don't reside when they do speaking engagements. Answer to that is yes. I'll talk a little about that now. So many of you will get public speaking engagements, and maybe you had them before COVID and you'll have them again after COVID. I work with some authors that are in demand in that manner. We use a practical approach. If somebody does one speech in one state and gets paid a couple $1,000 for that, we don't bother filing a tax return in that state that they're not a resident in. We look at the income, we find out the information about how much income is for each state, and we make a practical decision. Each state has minimum income that's not subject to tax. So, we try to do things that are administratively smart. So it's really on a case-by-case basis, but theoretically you should be looking at it and thinking about possibly filing in that state that you're not a resident of. And if you do have to pay taxes in a state that you're not a resident of, the state that you are a resident of gives you a credit for the taxes you pay to the other states. So you might be paying taxes to 2 states, but you're not paying double state tax. Somebody wanted to know the pros and cons of paying estimated taxes. Well, the pros are that you're following the rules and you're paying your taxes as you go, and you're avoiding potential interest or penalties for not doing so. The cons of paying estimated taxes are that you're paying taxes and no one likes doing that. I think you really should if you have to, and you should understand the rules. And the rules are a little complicated, so I'm not going to get into it in this part of the presentation. Let me see if there's any other questions that I wanted to talk about. COVID. People wanted to talk about PPP. I'll talk about that in the meeting. But one question was whether or not the PPP loans were forgiven as taxable income. So that was a big question for people who got PPP in 2020. The big question was, will that be taxable or not if it's forgiven? And the answer is, it is not going to be taxable. That's really great news for a lot of people. People wanted to know about the rules on withdrawals from retirement plans. In 2020, as part of the COVID relief package, the government suspended the required minimum distribution from plans for people who are over 70 and a half years old. And so that's what they did in 2020. I believe for 2021, the current rules are in place. So, and there's a new tax law also that basically says that the required minimum distribution age is now 72, but the temporary suspension has not continued into 2021. Foreign taxes, people want to talk about that. I'm going to deal with that on the presentation, so I'm going to skip that. But there is one question that I want to talk about now. Somebody asked about 6166 certifications. So that's a terminology that goes way back. But basically, if you have your work published outside of the United States, the foreign publisher will most likely need to withhold their foreign taxes from what they pay to you and your agent. There's a way to minimize that, and the way to do that is to file a tax certification with the United States. Basically, there's a form, it's called 8802, and you're basically certifying to the IRS that you are in compliance with the federal tax rules. They review your records, and then they send you a certificate that indicates as such. Then you provide that to the foreign publisher, and that enables the foreign publisher to withhold the least amount of taxes required by their laws. It saves you the withholding from the money that they pay you. The good news is, whether you do it or not, any taxes that the foreign publisher withholds is available to you as a foreign tax credit. That's part of the agenda today. We'll talk about that when we get going. I think I'm going to go to the program now and stop with the questions, because I know you'll probably have some more that are more current and topical. So I'm going to stop with the questions that we got previously. So today's program is going to be broken down into a bunch of bullet points, and I'm going to stop at the end of each one to just get some air and let you guys all get your questions out, to keep this a little bit interesting and not just me talking. First thing I want to talk about is just a basic update on the tax rules. Not much change in the tax rules in the last year or so. So some of this stuff is about 2 years old with the tax changes that happened in the prior administration. The top federal tax bracket is 37%. Deductions for real estate taxes and income taxes is limited to $10,000. And all these numbers I'm going to be talking about are based on filing a joint return. So the tax deduction limitation for state and local taxes is $10,000. That's a big hit for people who live in high tax states like New York and California. Standard deduction for people who do not itemize the deductions is $25,000 this year. Mortgage interest is limited in how much you're allowed to deduct. If you have A new mortgage, if that mortgage is more than $750,000, the interest is limited. So if, let's say you have a new mortgage for $1,500,000, the limit's 750, so half of that mortgage interest is deductible. The old rule was approximately $1.1 million. So for those of you who had mortgages prior to the end of 2017, you're under the old rules. And if you refinance an old mortgage and don't get more debt than is currently outstanding, you're grandfathered. The big thing that I think happened in the tax law that changed a couple years ago was this pass-through deduction called the QBI, qualified business income. So they reduced the tax rate for corporations to a flat rate of 21%. That was a big boon for big companies, and that's not us here today. So to be fair to self-employed people like authors, the government came up with a rule that said that certain businesses, and authors qualify for this, can take 20% off of their net income as a tax deduction so that they're only paying taxes on 80% of the net income. So if you're an author who makes $100,000 after expenses in writing, instead of paying taxes on $100,000, you pay taxes on $80,000. That's a really good thing. Once your income is greater than $326,000, the rules get more complicated. I don't know if anybody in this audience fits that category. If they do, maybe a question will come up. But there's ways to take advantage of the rules. And just like anything else, the more successful you are financially, the more tax loopholes and rules there are to understand and take advantage of. But I don't want to get into it if it's not that topical. So we'll see if any questions come up when I take the break for questions. So, time for a break for questions. Let's hear if we have any. You're muted.
All right. Is there any particular topic you want to address first?
If it's basically anywhere near the subject matter that I just went into, I'll take a question.
Okay. There's some specific questions. Like last year, you didn't have to withdraw from KEOG plans, KEOGH.
Right.
A few questions about those. Has that changed this year?
Okay, so maybe I talk fast, but I thought I covered that. So there was a suspension of requirements to take distributions from KEOs, SEPs, IRAs, retirement plans. That suspension expired at the end of 2020. As far as I know, the rules for required distributions exist for 2021 until we hear otherwise.
Okay. And are there pros and cons between those, SEP, IRA, and KEOGH?
That's a good question. That's going to be part of our topic later in the program. I'm going to talk about pensions. So I'll talk about all the different types of pension plans that there are and what works depending on the circumstances.
Great. All right. Are there concerns for people who moved around during COVID between states?
Yes, there are concerns. It's really, really complicated. People fled New York City. That's where I sit today, to be someplace more comfortable or maybe safer. Some of them were fortunate enough to have homes that they owned outside of New York State and city. And so they've spent, let's say, almost the entire year in a state, let's pick Florida. So in that case, they're probably thinking, since they lived in Florida for the whole year and Florida doesn't have any income tax, they should not have to pay any income taxes to the states this year because they were not in New York. Sounds good. I don't think New York State's going to like that too much. There's some rules that make that idea not as simple as it sounds. On the other side, if somebody leaves New York and goes to their country house in Connecticut, they probably think that they'll just pay taxes in New York like they always did because they're a New Yorker and they're not trying to do anything fancy or tricky with Connecticut. Connecticut may start to get aggressive and say, hey, I know you have a home here in Connecticut, and I think you worked here. Prove you didn't. And if you did, we want taxes on your income in Connecticut. New York's going to want their income too, their tax also. So it could get very tricky. No easy answer to that question. There's a concern.
Mm-hmm. On the 20% off rule, is there a minimum net income? And what form do you use to claim that?
Okay, I don't know the form number. Sorry, I don't know that number, but it's, if you Google it, it'll pop up really quickly. There's no minimum. If you make $10,000 as a self-employed writer, you're entitled to a $2,000 tax deduction. You make 100,000, you're entitled to $20,000 tax deduction. That's the rule. If you make more than $326,000, that tax deduction gets limited and phased out pretty quickly. So for the authors in the room that make, let's say, $500,000 from writing, you would not get the 20% off of that $500,000 unless you have employees. You need to have employees to take advantage of that rule. So what I see some authors do is they employ their spouse. They put them on the books. They actually put them on a payroll for $100,000 for administrative support and marketing services or whatever they do. Then that qualifies that author who now makes $400,000 to either take 20% of 400, limited to not more than 50% of wages. 50% of wages is $50,000. 20% of $400,000 is $80,000. That author gets a $50,000 tax deduction that's completely manufactured by the tax laws, solely by the fact that they were smart enough to make their spouse an employee. So it's a good planning opportunity for clients for people, authors who make more than $326,000 from writing. What else you got?
And does that apply broadly to freelance writers, translators? Is there a specific definition for authors to get that 20%?
If it's below $326,000, it doesn't matter. If it's over that, then there might be a concern about somebody being something called a specified trade or business. I happen to know that accountants are specified trades of business. So we are excluded from taking advantage of the rule unless we make less than $326,000. Lawyers can't do it. Certain people can't do it. The reason that they have this limit is because they didn't want the law to motivate people who were employees to run to their employer and say, I'd rather be a freelance person so I can take advantage of this 20% discount. But in general, it's open to anybody who is truly a freelance, independent contractor or a self-employed person. And as long as you're not making more than $326,000, you're probably going to be able to take advantage of the role.
Okay, that's great. All right, I think that covers it for that section.
Good for now? Okay, good. Let's talk about an area that helps people get organized. That's keeping your books and records in a good way and thinking about deductions and home office. So when a successful author comes to me and says, hey, I need to get my accounting in good shape and I want to pay the least taxes possible, the thing that's going to help me help them is for them to be organized. Nobody wants to pay me to do their bookkeeping. I'm too expensive for that. So I try to give people some good basic advice so that you don't end up with the big shoebox that comes to the accountant's office in February. So what I recommend you do is have a bank account that is used exclusively for the business. All the money you get from writing, whether it's an article from a magazine or a check from your literary agent or from your publisher, it goes into that bank account. All the money you spend in that bank account is used for business expenses, telephone, travel, entertainment, research, cable. I'll give you some deduction categories. I wrote them down before the meeting. You might pay money to a lawyer or for your tax preparing, for supplies, for travel, for meals and entertainment, for local transportation, for your car lease, your phone, your dues to the Authors Guild, postage and delivery, cable and internet, media research. So those last two items are kind of, I think, a little creative. Everybody in this phone call has cable and internet. And some people think that that should be maybe allocated for business versus personal. In my opinion, you need cable and internet to be a successful business person. You need a subscription to Netflix and other streaming services to be relevant and to be able to consume media and know what's going on. So all of those things I call media research, and you should take the deduction for them and pay for them with your business bank account. We also have credit cards. I understand lots of stuff gets paid for that way. So you don't have to get a special card for your business, but you should pick one that's in your wallet now and decide that that is the business card. So if you have two cards in your wallet, one's gold and one's green, pick one. Okay, the gold one. The gold one is business. So every time you use it, it's for business. This eliminates the need for you to go through the end of the year and cherry pick what's business, what's personal, what's business, what's personal. So you go out with somebody for dinner, you pull out the gold card. That's you declaring to yourself that this is a business dinner, and it's going to show up that way, and it's going to make your life a lot easier when you go through your year-end summary. So let the bank account and the credit card be really telling the story of the income and expenses of your business. That'll make it a lot easier for you to put it all together for you or your accountant at the end of the year. Home office deduction. So there's a rule that says that self-employed people who work from their homes, and this is probably more relevant than ever, self-employed people who work from their homes are allowed to take something called the home office deduction. That allows us to take a percentage of our interest and real estate taxes and deduct them on Schedule C from your business income rather than as an itemized deduction, which has some limits. The classic example is somebody works from their home in a home, let's say, that has 2 bedrooms. 1 bedroom is used exclusively for business. The square footage of that bedroom is, let's say, 150 feet. The whole house is, I'll make up a number, of 1,500 square feet. So that means that 10% of the entire house is being used for business. So you would take 10% of your mortgage interest and 10% of your real estate taxes and utilities and other stuff that's not normally deductible, that's for the house, and take it in the home office deduction. It's really great for people who don't own their own homes, people who rent. You're paying rent, you're not getting a tax deduction for the rent that you pay. But if you're self-employed working from your home, you take the same example. Say you have a really nice apartment that's 1,500 square feet. You're using one of the bedrooms for business, 10% of the rent is tax deductible from your business income as a self-employed writer. So it's a really nice thing. Some people get nervous about it. The question I always ask is, if I take the home office deduction, will I get audited? I don't know. The chances of a tax return getting audited is less than 2%. And I do know that tax returns that file Schedule Cs and or home office deductions get audited more often than the ones that don't. But the entire percentage of returns that get audited on an annual basis is less than 2%. So if you have a legitimate home office, you should be taking that deduction. There's a simplified method that was put in place a few years ago. I don't use it for any of my clients, but you can take $5 per square foot of space that you use for your home. And I think the maximum amount that you're allowed to use is, I forget the number, but it's just not enough to, usually the rent or the interest in real estate taxes and utilities end up with a better result. So most people don't use that $5 per foot standard. That's enough on records and deductions and home office. Open it up to questions.
That's great. One person asks, what if they work from home and from a co-working space? Can they deduct for both?
I would say maybe. If you're paying rent on a co-working space and it's available for your use all year round, and you're also working from home because you like to work at night when you're not in that co-working space, maybe you can take both. But the IRS would probably, if you were audited, they would propose that you're working from home for your own convenience. You have a place to go. You have a deduction for that expense already. And to have 2 places is not necessary for your business. You could argue otherwise. So the answer is maybe.
Can you deduct construction renovation costs like building a home office?
Yes, 1 second, my computer went to sleep. We're back, okay. So yeah, I was just talking to an author this morning. They have a home office in their basement and they had a flood and they had to spend $15,000 on some repairs. We're gonna take that deduction in full because it was confined to just that space. Some people start a new office. They're just starting to have a home office, so they spend money on painting or paneling or flooring or lighting or even furniture or things like that. All those things are deductible. How they get deducted is just a kind of a nuance. Home office deduction, maybe. On the Schedule C itself, maybe. But it's definitely something you want to capture and start to think about taking advantage of.
A lot of people are asking how aggressive you can be with various deductions, like travel that isn't entirely for work, um, books that you buy that are research or not. Um,
Yeah.
there's a rule of thumb.
All right. Well, I guess there's a couple of thresholds to think about. First is the moral and ethical threshold, which I'm not going to get involved in because I'm wearing a different kind of collar today than that person. But I can tell you that if you can get over that issue and you're a sound sleeper, if you buy books that you feel are directly or indirectly related to your work as a writer, you should be deducting the cost of those books. The other example you gave me, I'm sorry, it slipped my mind. Repeat the question again. Besides books,
Travel that isn't entirely
travel.
for
Okay,
work.
yeah. So people travel and they might bring their spouses. Okay. So some people would say that the spouse keeps you organized and keeps your itinerary and all of that kind of stuff. Well, maybe. I don't know if I want to argue that one. I would say that I would deduct the cost of your plane ticket, not theirs. I would deduct the entire cost of the hotel because it costs the same amount of money for one person to stay in the room as two. And then I would be selective with the meals that you have. Maybe you don't deduct the cost of the breakfast because that's personal. But the lunches and dinners, if you can document that you had the lunch and the dinner with somebody that's related to your work as a writer, whether or not your spouse was present, I would deduct the whole thing. There's nothing on the bill that says how many people were at the table. Again, this is a little subjective and subject to your own kind of moral compass. The tax system is a honor system, and everybody wants to be as honorable as they can, but there is definitely some gray area in that subject.
For deductions in general, can these all be taken in years when they don't have writing income?
So the answer to that is if you are a self-employed writer and you have years where you have had writing income and you are in between projects, it just happens that the year we're talking about had little or no income, I would say, yes, you should be taking the business deductions that are definitely necessary for you to be in the business of being a successful writer. I would be less aggressive on the discretionary business expenses in that year, just because I think it does maybe create a higher chance of being audited. And if you are audited, it might be hard to defend those discretionary expenses. But paying your lawyer and your accountant and your telephone and your dues is something you have to do to maintain your status as a writer. And again, if you are doing that in a year that you're not making money, but you have made money in past years and intend to expect to make money in the future, you should continue to take those deductions.
Okay, that's great. All right, should we move on? It's about 2:30.
Yeah, let's move on. Okay, next one I want to talk about is your income and how it's reported and the 1099 that you're getting from your agent or your publisher. The rule says for 1099s, I work with lots of literary agents as well, and I help them with their 1099s for their authors. The rules say that literary agents are supposed to report what they paid to their author clients on a 1099. They're supposed to report the gross amount that was earned by them. So if the agent gets $10,000 and takes their 15% fee and pays the author $8,500, the amount that's on the 1099 is supposed to be $10,000. Now you're supposed to know that. Hopefully your agent explains that to you. Hopefully you know this. When you get a 1099 for $10,000, you're not paying taxes on $10,000. You're going to report that you have $10,000 of income, and you're going to take a tax deduction on the line that says commissions for $1,500, so that you're paying taxes on the net of $8,500. And then you'll take all the other expenses that you have as well. So it's important for you to understand what's on your 1099 and how the agents are preparing them. I can tell you that more than half of the agents that I work with do their 1099s on a more logical manner, meaning if they paid their client $8,500, they're logically issuing a 1099 for $8,500. They don't know that there's a special rule about this for literary agents. Or if they do know, they've decided to not do it correctly because they didn't want to deal with 450 phone calls from their clients about changing from one way to the other. As software for 1099s and agencies becomes more prevalent, I am seeing that more and more agents are doing their 1099s on the gross method. So it's important for you to know what's there. When I get together with an author, I get the 1099. I call up the literary agent and I ask them to give me the detail that's behind it so we can see what's there. Because we find out that not only is it on the gross method and there's some commissions to take off on the tax return, but there might be some expenses that were taken at the source for reimbursement. And there might have also been some taxes withheld at the source, foreign taxes. And that's really important to know about because, as I mentioned earlier, if you pay taxes to a foreign country on work that's published in their country, you're allowed to take something called the foreign tax credit. So in an example where you got a 1099 for, let's say, $10,000, and the agent took $1,500 out for their commission, you have $8,500 of net income, but you also find out that they took $500 for foreign taxes. You're still going to report that you made $8,500. You're not going to take the tax deduction for the $500. Instead, you're going to claim the foreign tax credit. The foreign tax credit will reduce your federal taxes by $500. That's a lot better than a $500 tax deduction. So it's important to know what's in your 1099. Pay attention to the commission's expenses, and probably more importantly, if you have work published abroad, foreign taxes. Any questions? Mute.
Sorry. About 1099s and estimated payments, how to deal with it if unexpectedly large payments come in at the end of the year, how to avoid penalties in general.
Okay, it's a good question. Let's talk about that. So as I'm doing someone's 2020 tax return this month, I'm going to ask them what they think their 2021 is going to look like. Now, nobody knows. So the question is framed, will 2021 be better, the same, or worse? And if the answer is the same or less, then we have to really look at their income on a quarterly basis and estimate their taxes each quarter. This prevents us from overpaying our taxes. If the answer is, well, 2021 is going to be better than 2020 because I'm getting my next advance in May and another one in August. In that case, what we do is we give them 4 quarterly payments for April, June, September, and January. And the payment amounts that we give them is equal to 110% of the 2020 tax. We're assuming that 2021's taxes are going to be greater because the income is going to be greater. And by paying 110% of the prior year's taxes on a quarterly basis, it allows you to owe whatever balance is due with your 2021 tax return next April without any interest or penalty. You can owe unlimited amounts of money, even if you get $1 million on December 1st of 2021, whatever it is, you will owe that tax, but you'll be protected from interest or penalties. So what lots of our clients do is just do that protection method. Again, it doesn't make sense if you're going to have an off year. You don't want to pay taxes that you shouldn't be paying, but that's how we do it. Okay.
For people with mostly W-2 income and some 1099s, how does that impact self-employment taxes? And how should they do that?
So self-employment tax is based on your total earned income. Earned income comes from wages and self-employment income. The maximum income for the full self-employment tax is $146,000, I think, for this year. I wrote it down someplace, $143,000. So if you make $120,000 on a W-2, your employer took out Social Security and Medicare tax on that $120,000, and the remaining $23,000 of the first $23,000 of your self-employment income is subject to the full self-employment tax. Anything over that is only subject to the Medicare tax piece. The Medicare tax piece is much less than the entire tax. The total self-employment tax is about 15.3% between Medicare and Social Security. Once you meet the threshold, the $143,000 threshold, the Social Security goes away, and what's left is the 3% component of the Medicare. So 15.3 consists of 3% for Medicare and 12.3% for Social Security. That part goes away once you reach the 143. So if you earn wages more than 143, your self-employment tax is going to be very little, but it is on all of your income as a self-employed rider, but but only at the 3% rate rather than the full 15%.
I see. Someone says, I've done book proposals for clients who simply write a $5,000, $10,000 personal check and don't 1099 me. Must I report?
Okay. Yes, we have an honor system. We are supposed to report our worldwide income. So if you get a check for $5,000 and deposit it into your bank account, whether you get a 1099 or not, you're supposed to report that as income on your tax return. If you have expenses against that, you should also deduct those expenses from that $5,000. But failing to report income is a big no-no. And in the unlikely event that you're audited, it's one thing to have an expense for a meal challenged and disallowed. You pay the tax and some interest. But failure to report income results in tax, interest, and penalties.
Okay. Several people are concerned about their 1099s not having the tax withholding reflected. What should they do if they're not sure that they're getting the right documents sent to them?
Well, they should, whoever gave them the 1099, they should call them up and ask them for the support, the backup that supports the information.
Okay. Oh, you mentioned the foreign tax credit. Why is that better than the, why is a $500 foreign tax credit better than a tax deduction?
Okay, good question. Let's say you're in the 20% tax bracket. If you deduct the $500 as a tax deduction, it's going to save you $100 in taxes, right? 20% tax bracket, $500 tax deduction, saves you $100 in tax. If you take the credit, you save $500 in tax because you're getting 100% of the tax withheld as a credit from your federal taxes instead of only 20%.
Okay. All right. Should we move on to another topic?
Yeah. Let's talk about pension plans, retirement plans. So people were asking about KIOs and SEPs and IRAs. So all of these things are acronyms for retirement plans. The government has plans in place that allows us and motivates us to put money away for the future and get a tax deduction now for doing so. So the most basic retirement plan is an IRA, an individual retirement account. If you have earned income from wages or self-employment and you're not part of a pension plan someplace else, there's really no restrictions on the IRA amount. You can put up to $5,500 away into an IRA. If you're over 50, extra $1,000, so up to $6,500 if you're over 50. You can put it into an IRA account that you open up at your favorite institution. You can get a tax deduction on your tax return for that money. That money grows theoretically over the years on a tax deferred basis. And if you take it out after you're 59 and a half years old at some point, voluntarily, whenever you want, or mandatorily, if you're over 70 and a half, 72, I think it's now. When you take that money out, you pay regular taxes on it based on the tax rates that are applicable at that time. But all that growth was tax deferred, and that really adds up to a lot of money. There are something called Roth IRAs. Roth IRAs are like an IRA, except when you put the money into the IRA, you don't get the tax deduction on your tax return. But in exchange for not getting that tax deduction, you get that income later on tax-free, not tax deferred, tax-free. When you take that money when you're 59 and a half or older, the money you take, all of the money you take, including the growth, is tax-free. So Roths are really, really cool for people who are young, who don't have a high tax bracket, and hopefully, don't need the money to pay their rent or their happy hour bar tab. They can put money into a Roth IRA every year while they're young and forget about it. And 40 years later, it's worth a lot of money. And when they take that money, it's really tax-free. It's a great planning opportunity for most people. Let me just get back to my computer. It's turned off again. Okay, go back. The next step up for retirement plans is something called a SEP. SEP stands for Simplified Employer Pension. That's really something that's, I see, common for authors. If you're an author who's self-employed and you're making more than enough money to pay for your basic everyday living expenses, you should be thinking about doing a SEP. A SEP allows you to deduct anywhere from 0 to 20% of your net income from self-employment and put that money into a SEP account. Same rules as IRAs. It's tax deductible when you put it in. It's taxable when you take it out. So if you're an author that made $100,000 net of expenses and you have the ability to do the maximum SEP deduction, you're going to take $20,000 of your money from your left pocket and put it into your right pocket, SEP account. Doing so will get you a $20,000 tax deduction. You got to do that before you file your tax return. I should say that one of the cool things about SEPs is that they're not due until you file your return, as opposed to IRAs. IRAs are due by April 15th, whether you file on April 15th or take an extension and file after. SEPs are allowed whenever you file your return. So if you want to do a $20,000 SEP, but you don't have the money today or next week, a lot of clients I work with will take an extension. They know they're going to do the $20,000. They're saving up $5,000 a month. They get the money ready. They put it into the plan in May or June, and they file their tax return. So that's the difference between the due dates for funding an IRA versus funding a SEP. SEPs are great for self-employed authors who don't have employees, and most authors I know don't have employees. In the example I gave before, where an author wanted to take advantage of the QBI rules and make their spouse an employee, we also let that spouse participate in the SEP. So the author got a maximum SEP contribution, which last year was $57,000. They put $57,000 into their SEP. They put $57,000 into their spouse's SEP. And they got $114,000 tax deduction by putting money away for the future. As I said before, these rules are really good for people who make a lot of money. They get complicated, but really beneficial. So IRAs, SEPs. Those are the ones I really wanted to talk about. There's a couple others that are probably a little bit outside of the scope of today's program, but there are other programs that are more lucrative, but more complicated also.
Some people have asked if you're older, if you're over 66, can you invest in a SEP? Can you start a pension fund if you're over 70? Things like that. Yeah.
If you're still working, if you still have self-employed income, you can do it. Now, so if you're in your 60s and you're still working, you're going to do it, and it's great. And it'll be there when you're ready for it, when you stop working. I have clients that are in their 70s. They're required to take a minimum distribution every year because they're over the 70-something years old requirement, but they're also active as writers. So every year they do the maximum SEP, they put the money into the SEP, get the tax deduction, and then they take it right back out because they're required to because of the RMD rules, the required minimum distribution rules. So it's a big circle. The point is, yes, you can.
Okay. If someone's opening an IRA for the required minimum distribution benefits this year, do they have to wait until next year to make donations?
I'm not sure I understand the question.
Okay. Maybe I don't either.
It's okay. Next.
So SEPs are different from IRAs. They're often called SEP IRAs.
SEP IRAs are SEPs. IRAs are what I said, and SEPs IRAs are the same thing.
Okay. Would you recommend self-funding both a Roth and an IRA if you don't receive retirement benefits through work?
Well, I think that you're limited to the maximum amount you're allowed to put into any kind of IRA is $6,500 if you're over 50. So you can't do $6,500 in each type of IRA. You got to pick which one you can mix it up, or you can do one or the other, but you can't do more than $6,500 into IRAs or Roth IRAs or both.
Okay. All right, should we move to the next topic?
Yeah. Next is, let's talk about entity choices of entity. So a lot of people ask me, hey, I just got my first book contract and I think I should be a corporation. Someone told me I should be incorporated. Maybe. We talk about that. So in order for it to make sense, the costs to be less than the benefits to be incorporated, you have to make a certain amount of money. So let's talk about when it makes sense and it doesn't make sense. So I mentioned before that the maximum income that you can make that's subject to self-employment tax is $143,000. So this author calls me up and says, hey, I just got a new deal. I'm ready to be incorporated. I say, how much is your advance going to be? They say $100,000. That's great. How much is it going to be next year? 100,000. Next year, 100,000. Good. So 3 years in a row, $100,000. That's awesome. Probably doesn't make sense to be incorporated. I'll tell you why. You'll figure it out in a second. In that different conversation, they tell me that they're going to get a $900,000 advance in $300,000 chunks over the next 3 years. Well, we know that the first $143,000 a year is subject to the full self-employment tax. If you become an S corporation and the S corporation makes that $300,000 instead of you, S corporations don't pay self-employment tax. So the entire $300,000 is not subject to Social Security and Medicare tax. That's great. Well, you can't be an S corporation and completely avoid the self-employment tax. That's a big red flag and you'll get nailed on that one. So what we do is we take that self-employed author who's now an S corporation and we say, let's come up with a salary that makes sense. Let's pick a salary number that we can use to pay some Social Security and Medicare tax as a gesture of goodwill to the IRS for your services that you render to your S corporation. So you're an employee for $50,000. You pay some Social Security and Medicare tax on the 50. We can use that 50 as a vehicle for being eligible for a SEP. We do the maximum SEP on wages. Wages maximum percentage is 25%, not 20. So 25% of $550,000 is $12,500. So we put $12,500 into a SEP. The rest of the money that the S Corp makes is yours to keep and pay, of course, federal and state taxes on, but you do not pay self-employment tax on any of it. It's really great. And the more you make, the better this is. You make $1 million, you pay yourself a $250,000 salary, you get the maximum SEP of $57,000. The other $750,000 that you make is completely free of any Social Security and Medicare tax. It gets better and better the more you make. So, you know, there's costs to being an S corporation. You have to have separate books and records. You need an accountant who can help you do the tax return. It's a little bit more formal than being self-employed without being incorporated, but the benefits are so much better than the costs. So you might pay a couple $1,000s for an accountant to help you out with that on an annual basis, but you'll save tens of thousands of dollars being an S corporation. People ask about LLCs. I don't want to be an S corporation. I want to be an LLC. That sounds better than S corp. Okay, why? I don't know. Tell me. Okay, so we talk about it. LLCs stands for Limited Liability Company. And all it really is just a different vehicle for some legal protections that really are not really part of this conversation because we're talking about taxes, not legalities today. But if you do an LLC as a self-employed author, for tax purposes, you're treated exactly the same way you would be if you don't do an LLC. There's no difference between being an individual sole proprietor author and an author who has an LLC. No difference. Same rules, same taxes, same self-employment tax, everything's the same. So I don't see a lot of authors doing LLCs. I see authors mostly being sole proprietors. And if they are fortunate enough to make the numbers that I was talking about before, yes, then we talk about being an S corporation. That's all I want to talk about on the entities.
Okay. Yeah, there's no specific cutoffs or thresholds that people need to make those decisions.
You know, I used an example for $300,000. That's a pretty good conversation starter. You know, the greater the number, the more compelling it is. But anything less than $300,000 on a regular, you know, ongoing basis is not that beneficial, and the costs become, you know, significant compared to the benefits, and it just doesn't make any sense for the complexity.
Okay. All right, so you want to move on?
Yeah. So the last topic I wanted to get into is PPP. People asked about PPP in the beginning of the call. They wanted to know if the PPP that they got in 2020 that was forgiven would be taxable, and the answer is no. That's great news. Well, there's new PPP. PPP2 is out right now. And I think the government's making it easier for small businesses this week and next week to actually apply for that. So I pulled up some rules from the SBA before the call to see, you know, how that might apply to self-employed authors. So if you're a self-employed author, you can go to the form on the SBA website. I think the form is 2483 and apply for the second draw of the Paycheck Protection Program loans. There's a bunch of forms to check and boxes to check. But the two things that are really, I think really important is you need to be able to check a box that says that the current economic uncertainty makes this loan request necessary to support the ongoing operations of your business. I think that's pretty fair to say for anybody. We don't know what's going to happen. The second thing is you have to, in order to qualify, is you have to have realized a 25% reduction in your revenue for any quarter in 2020 compared to any quarter in the corresponding quarter in 2019. So you look at your bank account and look at what happened, let's say in the second quarter of 2020. That was a bad quarter for a lot of people. April, May, June 2020, gross receipts were $10,000 in 2020. You look at the same quarter for 2019, gross receipts deposited in the bank was 20,000. You had a big reduction. You had a reduction that was greater than 25%. You qualify. Okay, now you qualify. That's great. So how much money can you get? You look at your 2019 tax return. You look at your Schedule C, what your net income from self-employment was, and you're allowed to take that number, limited to $100,000. So if you made more than $100,000, you start with 100, divide it by 12, and multiply it by 2.5. That number comes out to approximately $21,000. So the maximum loan you can get as a self-employed writer is $21,000 if you are eligible. And that's the maximum. So if you're an author that has a net income of $10,000, you could be eligible for $2,100. It's the net income divided by 12 times 2.5. If you have employees, it's more complicated and more lucrative. I don't think most people have employees in this conversation. So I think the point of this is that a couple things. PPP is forgivable. PPP is tax-free, and new PPP money is available and not that hard to get. Check out the websites, SBA Form 2483. That's that.
Great.
Any final questions?
I'm not sure if this is in your realm, but a few people have asked about literary estate things. For instance, is there a purpose in putting literary works into a trust or an LLC for future financial benefits?
Yeah, that's a little bit outside of what I do. I have partners in my office that deal with lots of trust and estates matters, and we do see people doing that. It's usually for estate planning purposes. If you're a really successful author and you expect your estate to be subject to potential estate taxes, then what you might do is put your copyrights into a trust so that it can be exempt from estate taxes. And there's lots of other reasons to do it, but it is beyond the scope of today's conversation.
Sure. Somebody asked, what's the number one mistake you see authors make other than not keeping good records?
Believe it or not, the number one mistake I see that they make, or the one that really just makes me so surprised, I should say, most shocking, is that they forget to deduct their agents' commissions. It's just so mind-boggling to me. They don't realize that they need to deduct it. They just take what's on the 1099 and pick it up as income, and they don't realize that the 1099 it did not report the deduction for the commissions. Hard to believe, but I see that pretty often. The other mistake I see that is made that's not shocking, it's more understandable, and it's quite common. People will, before they come to me, they'll give me a copy of their tax return, and it'll show that their income from writing is on something called Schedule E, which is where you record rents and royalties. Seems logical, royalties. Schedule E is not subject to self-employment tax, and that's a mistake. And so I have to convince the author that they should have paid self-employment tax on that income. And we can talk about amending the returns. But if you want me to do your returns this year, we're doing it on Schedule C, and we're paying self-employment tax. And usually they say, okay. Sometimes they say no.
Great. Well, thanks so much, Mr. Pesce, for answering our questions. This has been very informative. Thanks to everyone for joining us. And also, we are beginning to plan many more financial literacy related webinars for this spring and summer. So everyone should stay tuned for plenty more good stuff. Again, thanks to everyone who came, and thank you. Thank you, Robert.
You're really welcome. Anybody in the call that needs any follow-up, please feel free to get in touch with me. I'm always happy to answer questions offline. Have a great day, everybody.
Excellent. Thanks. Bye-bye.
Bye.